Hi everyone, my name is Edwin Lim. In this video, we will cover topic 9. In the first half of the topic, we concentrate on the accounting for acquisition, depreciation, revaluation, impairment, and disposal of property, plant, and equipment. In the second half of the topic, we will cover the accounting treatment of intangibles. Please go through the learning objectives. Before we move on, let's go through revision question or case study 8. This case is related to inventory cost below assumptions. Armstrong Flooring is a leading global producer of flooring products that is incorporated in the US. During the fourth quarter of 2016, Armstrong changed the method of accounting for their wood flooring segment inventories from last in first out LIFO to first in first out FIFO. You are required to answer the following two questions. First, in the US, companies are allowed to use the LIFO cost below assumption. Why is this assumption prohibited in other countries, including Australia? So there are a few points that you can mention. First, that is because LIFO is not conceptually sound. Many companies will not sell the later purchase before their earlier purchase. And if there is an issue of inflation, the closing inventory does not reflect the current value of inventory. This is because under LIFO, we use earliest purchase inventory to calculate the closing inventory, which suggests that the figure is outdated and much lower. And when things become more expensive, LIFO overstates cost of goods sold because cost of goods sold is based on the latest purchase inventory at higher price. So this will understate profit and lead to greater tax savings. In the next question, you are required to look from a financial reporting perspective and identify the possible reasons driving Armstrong to switch from LIFO to FIFO cost below assumption. First, it is to more faithfully reflect business performance. The switch to FIFO matches the nature of the wood business. The wood business has a long production cycle because it takes a few months from the purchases of lumber to the sale of finished goods. And FIFO will better match manufacturing costs with revenues. And another possible reason is driven by volatile lumber prices. Under FIFO, newest items will remain in the inventory at the most recent price, so we can avoid unusual increase or decrease in cost of goods sold during periods of fluctuations. And most importantly, as mentioned in the article, most industry peers use FIFO. So this allows for better comparability of accounting information. Alright, let's go through today's topic. We start with PPE that is covered by IAS 16 or AASB 116. The standard defines property, plant, and equipment as tangible items held for either one of the following functions. So we use PPE for the production or supply of goods. So for example, machinery, vehicles, and we also use PPE for rentals to others, for example, warehouse, or for admin purposes such as office building. And we expect to use these assets to generate economic benefits for more than one accounting period, meaning we can use that beyond 12 months to generate economic benefits. And that's why they are classified as non-current. And examples of PPE include land, buildings, machinery, vehicle, furniture, computers, and so on. AASB 116 guides us on how to initially measure the cost of PPE. What can and cannot be included as cost of PPE. It tells us when and how to depreciate PPE. it tells us what to do with additional expense incurred after the purchase of PPE. For example, how do we treat maintenance expense? Can we treat maintenance expense as part of the cost of PPE? And ESB 116 would tell us how to subsequently measure PPE, specifically whether we revalue an asset or we impair an asset. And note that revaluation and impairment are two different concepts. When we talk about revaluation, this is not compulsory. It is optional. But once we apply revaluation, it must be reviewed regularly. And with revaluation, we can actually write up or write down the value of the PPE. On the other hand, impairment testing is compulsory, and it is compulsory to write down the asset value if the asset is impaired or damaged. And for impairment, we only write down the value, and we will refer to IAS 36 or ESB 136 impairment of assets for the treatment. And finally, sometimes we get rid of our assets or we sell our property, plant and equipment. And how do we account for that? We also need to rely on ESB 116 in this regards. According to ESB 116, we initially record property, plant and equipment at cost, meaning historical cost. PPE is a form of goods. It will attract GST. But when a business purchases PPE, it will have GST recoverable. So we debit PPE. So when we debit PPE, this amount does not include GST. It is net of GST. And then we debit GST clearing, and we credit bank or accounts payable with the GST inclusive amount. And there are three parts to the cost of PPE. First, purchase price, which also includes import duties and non-refundable purchase taxes. So if you have any taxes that are non-refundable, you can also include it as cost of PPE. So here, we do not include GST because GST is refundable. So it does not meet this criteria. That's why we exclude GST when we record the cost of PPE. But we need to exclude trade discounts and rebates, because trade discounts and rebates cannot be part of cost of PPE according to the standard. And second, any direct cost to bring the asset to the location and condition for intended use. So what are those examples? You can think about construction wages. You can think about delivery costs, initial delivery costs, and installation and assembling costs, as well as some professional fees, legal fees, for example. For example, when we purchase the asset, we will hire a lawyer, a solicitor to write up the contract. So the fees can actually be included as cost of PPE. And third, any initial estimated future costs. And what are those future costs? For example, dismantling costs, removal costs, or restoration costs. Because let's say for a building, we can only use it for 30 years or 40 years. And 30, 40 years later, we have to actually take down the building. And there will be costs incurred. So the removal costs can in fact be estimated and be included as part of the cost of PPE according to the standards. And note that for cost of PPE, we do not include admin costs and indirect costs. So this slide lists some initial costs that may incur when we purchase an office block or when we construct an office block, and some costs that will be incurred when we purchase a new computer system. So you can go through those details, and these costs can be included as costs of PPE because they are direct costs. Student task. So based on the given information, please calculate the cost of the machine and prepare a journal entry for the acquisition of the machine. So let's assume that you have attempted this question. First of all, we should identify which cost can be included in the cost of PPE. we can include invoice price, delivery charge, installation materials, and setup labor costs, because all the four that I've given a tick are direct costs. We must, however, take out the GST for the first three costs, the invoice price, delivery charge, and installation materials, when we calculate the cost of PPE. And with respect to the setup costs, it is provided by in-house labor, so there is no GST. And this amount has already been paid, so the setup cost has already been paid, but the first three costs are unpaid, so they are payable. And we cannot include the insurance expense, because insurance expense is not a direct cost, and it does not improve the capacity of the machine to generate more economic benefits. So let's calculate the cost of the machine. We start with the invoice price net of GST, so which is 218,181.8. We then add the delivery charge net of GST, 1454.5. We add installation cost net of GST, 2363.6. Then we add setup costs, 4250, and there is no GST for this cost because it is provided by in-house labor. So the cost of the machine is 226250. To record the acquisition, we debit machinery, plant and machinery, 226250 from part A, and we debit GST clearing. And how do we get GST clearing figure in this case? So we sum up the three GST inclusive amounts from the invoice price, delivery charge, and installation materials. So 240 plus 1.6 plus 2.6 times 1/11. So we get 22.2k as GST clearing. And then we credit accounts payable or cash. We credit accounts payable because the invoice, the delivery, and the installation haven't been paid for. So we credit accounts payable with the GST inclusive amount 244.2k. And then we credit bank because we have only paid for the setup cost, 4250. And we also need to record the insurance expense, although it is not cost of PPE. So debit insurance expense, net of GST 2909, and debit GST clearing 291 because insurance is a form of service. When we purchase service, we can claim for refund. So debit GST clearing or debit GST recoverable 291, and we credit bank with the GST inclusive amount 3.2k. After we record the asset, we should think when to depreciate the asset. When do we start depreciating the asset? Once the PPE or once the asset is ready for use to generate revenue. And why do we depreciate PPE? Because PPE is subject to wear and tear. We can only use PPE to generate revenue for a limited period of time. The service capacity of a machine that we purchased 10 years ago will decline over time. So we should recognize depreciation expense to internally adjust the value of PPE. And note that there is one exception here, which is land. Land is not depreciated because it has unlimited lifespan. If we were to define depreciation, it is to systematically allocate the cost of PPE over the useful life to match consumption or usage of the asset, which is a form of expense, against revenue earned from using the asset. And note that depreciation is not a market valuation process because we do not look at market price when we estimate depreciation. And it shows how much internally a firm has consumed the PPE. Different firms use the same PPE in different ways, and therefore depreciation is only an internal adjustment, not market valuation. And because of this reason, depreciation reflects value in use rather than value in exchange. When we estimate the depreciation, we also make some professional judgment. For example, what is the useful life of the PPE? Meaning how many years do we expect to use the PPE to generate economic benefits? What is the residual value of the PPE? In other words, what is the scrap value or the resale value of the PPE? How much will we receive when we resell the PPE at the end of its useful life? And how is the usage pattern? Do we use it equally every year or based on different usage? And there are three common methods to estimate the depreciation: the straight line method, the reducing balance method, and the units of production method. The choice of the depreciation method should reflect the pattern of use of the asset. And it does not matter which method we choose, we will end up with the same journal entry. So we perform the following adjusting entry: debit depreciation expense, credit accumulated depreciation. However, the depreciation method that we choose will give us different amount for depreciation. So what is accumulated depreciation? Accumulated depreciation is a contra asset account or a negative asset account. It shows the total depreciation expense recognized to date, meaning how much depreciation has been recognized so far. On balance sheet, we disclose the following: cost minus accumulated depreciation. That will give us the book value or the carrying amount of the asset. Now let's go through the first depreciation method, which is the straight line method. Straight line method should be used when the consumption pattern or the benefits flow of the PPE is equal or it is even. For instance, the use of office furniture. Under this method, we will record the same depreciation expense every year, and we use this formula: cost minus residual value divided by useful life. For example, the cost of van is 40k, useful life is 5 years, and residual value is 5k. Depreciation expense in year 1 and every year will be 7k, which is cost 40k minus residual value 5k divided by useful life. And accumulated depreciation in year 1, year 2, and year 3 will be 7k, 14k, and 21k respectively. And the carrying amount is calculated as cost minus accumulated depreciation in year 1, year 2, and year 3. So the carrying amount will be 33k, 26k, and 90k respectively. The next method is the reducing balance method. This method should be used if the property, plant, and equipment helps generate more benefits in early years. So it will be depreciated more at the start. For example, IT equipment, like computer. So under this method, depreciation expense will be greater in earlier years and they will become smaller over time. And we calculate using the following formula: cost minus accumulated depreciation times depreciation rate. And note that we ignore residual value in this case. For example, if the cost of the van is 40k and the depreciation rate is 25%, in year 1, the depreciation is 10k, which is calculated as 40k minus 0 times 25%. And the carrying amount, 40k cost minus accumulated depreciation for this year, 10k, that gives us 30k. In year 2, the depreciation expense is 7.5k, which is calculated as 40k of cost minus 10k accumulated depreciation from the previous year times 25%. And the accumulated depreciation for this year, in year 2, will be 17.5k, which is 10k plus 7.5k, that gives us 17.5k. So the carrying amount is cost 40k minus accumulated depreciation 17.5k, and that gives us 22.5k. And in year 3, the depreciation expense is 5625. And how do you get that? 40k of cost minus accumulated depreciation from the previous period, 17.5k times 25%. And the carrying amount is 40k of cost minus accumulated depreciation of 23125. And how do we get 23125? 17.5k plus 5625. And our carrying amount in year 3 will be 16875. So the graph at the left hand side compares the depreciation expense under the two methods. The depreciation expense for the straight line method is a straight horizontal line, but the depreciation under the reducing balance method looks like a convex, because we have higher depreciation expense in earlier years and smaller depreciation expense in later years. The graph at the right hand side illustrates how the book value will look like under the two methods. The book value will decline in a straight line manner because book value declines by the same amount every year under the straight line method. However, under the reducing balance method, it declines like in a convex manner, because the reduction in book value is greater for earlier years and smaller for later years. Alright, student task. In this case, the company purchased a machine for 44k inclusive of GST on 1st January. The useful life is 4 years, residual value is 8k. So you got to be careful in this question because the 44k is inclusive of GST. When we record the machine, when we record the PPE, we must take out the GST. So what are you required to do in this question? You are required to calculate the depreciation expense and accumulated depreciation for each year under the two methods, straight line method and the reducing balance method. When the reducing balance method is used, the depreciation rate is 33.2%. So let's assume that you have actually attempted this task. Depreciation in year 1, okay, and every year will be the same. That will be $8,000 because cost $44,000 times 10 over 11 because we want to take out the GST. This must be net of GST. So the cost is $40,000 minus residual value of $8,000 divided by 4 years of useful life. That gives us $8,000 per year. And accumulated depreciation for year 1 will be 8,000. Year 2, 8k times 2, 16k. Year 3, 24k, which is 8k times 3. And year 4 will be 32k, which is 8k times 4. And what is the carrying amount at the end of year 4? Cost 40k minus accumulated depreciation 32k, which is the accumulated depreciation in year 4, and we get 8k. So that is the carrying amount at the end of year 4, which is also the residual value or the scrap value. Under the reducing balance method, we apply the formula, which is cost less accumulated depreciation times the depreciation rate. Year 1, the depreciation is 13280. So we take 40k, and there is no accumulated depreciation from the previous year because this is the first year. So 40k minus 0 times 33.2%, you get 13280. And the accumulated depreciation for first year is also the same, 13280. Then in year 2, we calculate the depreciation, 40k of cost minus 13280, which is the accumulated depreciation from the previous year, times 33.2%, we get 8871. And we sum the two figures, 8871 plus 13280, so the accumulated depreciation is 22151 for year 2. Then in year 3, 40k of cost minus accumulated depreciation from year 2, 22151, times 33.2%, we get 5926. And then we sum 5926 and 22151, we get the third year accumulated depreciation as 28077. Then, in year 4, we take 40k of cost minus 28077 accumulated depreciation from year 3 times 33.2%, we get 3958. And we add 3958 to 28077, and we find that the accumulated depreciation is 32035 for year 4. Okay, and you find that because as suggested by the term reducing balance method, the depreciation that you charge for each year will become smaller and smaller. So what is the carrying amount of the asset at the end of year 4? 40k of cost minus accumulated depreciation from year 4, 32035, that gives us 7965. Alright, let's look at the third method, unit of production method. Unit of production method should be used if the consumption patterns or benefits flows are uneven or unequal, meaning sometimes you use more, sometimes you use less. So under this method, depreciation expense will be volatile. For example, vehicle and machinery, you can use this unit of production method. And the calculation can be based on activity such as machine hours or output such as how many units of products. So the formula can be calculated as cost minus scrap value divided by estimated units of a useful life times actual units of activity for the period. So student task. In this case, the company purchased a machine for 18k with a residual value of 3k, and it is expected to have a useful life of 12,000 hours. So meaning we estimate that the machine can operate for 12,000 hours over its useful life. But in year 1, the machine only operated for 4,000 hours, and in year 2, the machine operated for 2,500 hours. So calculate the depreciation expense for the first 2 years and show the carrying amount of the machine at the end of year 2. So let's assume that you have attempted this question. We will use the following formula: cost minus scrap value divided by useful life in units times actual usage per year. So if cost is 18k, scrap value is 3k, and useful life in units is 12,000 hours, we get $1.25 per hour. In year 1, the machine was operated for 4,000 hours, so 4,000 times 1.25, $5,000 as the depreciation expense. And in year 2, 2,500 hours times $1.25, that is 3,125. And what is the carrying amount at the end of year 2? So we take cost 18k minus accumulated depreciation 8,125, which is 5k plus 3,125. So we get 8,125. So the carrying amount is 9,875. After purchasing the PPE, there will be additional expenditure incurred, and we should know how to account for those expenditure. If the additional expenditure incurred after acquisition can increase the useful life, production capacity, or residual value of PPE, then we will capitalize this expenditure, meaning we record them as an asset. When we say we capitalize something, it means we record it as an asset. Okay? If the expenditure does not increase the useful life, does not increase the production capacity, does not increase the residual value, we have to treat them as repairs and maintenance expense, meaning we cannot record them as an asset. Following this, we are going to look at the disposal of PPE. When an asset is sold, disposed, or no longer generates future economic benefits, they will be removed from the account. When an asset is disposed, we need to first update the depreciation charge to date, meaning we need to update our accumulated depreciation because we need our accumulated depreciation to calculate the book value. And then we will compare the book value with the sale proceeds of the asset in order to identify if there is any gain or loss on sale. And then we record the sale. So let's have a look at the pro forma entry. How do we account for that? Because we try to get rid of PPE, and to remove asset from balance sheet, we have to credit the asset at cost or at fair value. And then we must close the accumulated depreciation with a debit entry with the most recent updated total figure. And we will debit cash or receivables for the sale proceeds, and we will have loss on disposal or gain on disposal. If we have loss on disposal, we will put it at the debit side. Alright, so we will debit loss on sale or loss on disposal if the sale price is less than the book value. On the other hand, if the sale price is greater than the book value, we will have gain on sale. For gain on sale, we will put it at the credit side. Student task. In this case, the company purchased an industrial refrigerator for 1.32 million inclusive of GST. So be careful because later on when we recognize the refrigerator, the PPE, we need to take out the GST amount. So the purchase is done on 1st of July 2011. Expected residual value 75k, useful life 10 years, depreciated under straight line method, and the machine is sold for 400k on 30th June 2016. So meaning 5 years later, after they have used the machine for 5 years, they sell the machine. So we are required to record the purchase of the machine. So the purchase of the machine will happen on 1st of July 2011. The first year's depreciation, so that will happen on 30th June 2012. And we need to record the sale of the machinery, so that will happen on 30th June 2016. So dates are required, narrations are not required for these student tasks. Let's assume that you have attempted the question. So on 1st of July 2011, to record the purchase of machinery, debit machinery 1.2 million, so net of GST, debit GST clearing 120k, and credit cash 1.32 million GST inclusive amount. At the end of first year, which is 30th June 2012, we calculate depreciation and we do the following entry: debit depreciation expense, credit accumulated depreciation. So 1.2 million minus the residual value 75k divided by 10 years of useful life, that gives us 112.5k for every year. Then on 30th June 2016, we sell the machinery, we sell the refrigerator. So to get rid of the asset, we credit machinery with $1.2 million. And then we need to debit accumulated depreciation because we close accumulated depreciation for this account, for this asset. So 112.5k times 5, because we have used it for 5 years, 562.5k. So what is the book value? We can use the cost of machinery 1.2 million minus 562.5k. So we know that the carrying amount or the book value is actually 637.5k. Okay, so 1.2 million minus 562.5k, the carrying amount is 637.5k. Then we receive cash $400,000. We sell at $400,000 because our sale proceed is less than carrying amount 637.5k, meaning we sell at a much lower price. We actually have a loss on sale. So the differential amount is 2 37,500. That is loss on sale with the debit entry. Now let's look at the subsequent measurement of PPE. Subsequent measurement means from the second time onwards, how do you measure an item? And why do we need to look at subsequent measurement? Because PPE is an asset account, and we know that asset accounts are permanent accounts. They are carried forward from one period to another, so they must be subsequently measured. Accounting standards give two choices for subsequent measurement of PPE. So either we use the cost method. If we use the cost method, it means we use the historical cost. Or we can use the revaluation method. If we use the revaluation method, it means we use fair value. And of course, you will learn fair value in greater extent when you cover more advanced accounting units. But note that, why do we want to use fair value? Because we try to correct the limitation of historical costs. When we cover measurement in topic 4, we already mentioned historical cost is backward looking. It becomes less relevant when time passes because it ignores inflation. For example, we purchased a building 10 years ago at $200,000, which is the historical cost. But now the building may actually worth $1 million based on the market price. So in this regards, fair value, the market value, is actually more relevant because it reflects the current value of the item. But to use the revaluation model, there is a condition that we need to satisfy. We must show that there is an active market. If there is no active market, we cannot use the revaluation model. If there is no active market, we have to rely on the cost model instead. And how do we prove there is an active market? So to show that there is an active market, we need to show that there are many buyers and sellers. Okay, so many buyers and sellers. We also need to show that the items are identical, so they are similar. And we must make sure that the market price information is publicly available. Okay, so many buyers and sellers, the items are identical or similar, and the price information is publicly available. For example, we can refer to the internet and get the market price of the item. So only we can use the revaluation model when there is an active market. If not, we stick to the cost method. And note that the revaluation model is optional. It is not compulsory. But once we apply the revaluation model, it needs to be reviewed regularly. When we revalue the PPE, the increase or decrease in the fair value of the asset will be recorded in OCI, other comprehensive income, and OCI is not P&L. And the increase or decrease is accumulated or reduced in asset revaluation surplus, which is an equity account. So what does this mean? Let's have a look at one example. At 30th June, Manu Limited revalued the land from 1 million to 1.7 million. Okay, so to revalue the land upward, we debit land 0.7 million and we credit gain on revaluation of land, which is an OCI account $700,000. Then immediately we close this gain on revaluation of land OCI $700,000 with a debit entry, and we transfer the figure to revaluation surplus, which is an equity account $700,000. Following that, in the second year, let's assume that you revalue the land downwards to 1.6 million from 1.7 million. So to decrease the value of the land, you credit land $100,000 and you debit loss on revaluation of land, which is an OCI account, $100,000. And immediately you close this loss on revaluation of land because this is a debit entry. When you close it, you credit it. So you credit loss on revaluation of land and you transfer this amount to revaluation surplus 100K. Following this, let's look at impairment of asset, which is covered by IAS 36 or AASB 136. The standard requires companies to review the impairment of assets at least annually. An asset is impaired if the carrying amount is greater than the recoverable amount. And note that impairment testing or the recognition of impairment loss is not optional. If the asset is impaired, we must write down the asset value. Otherwise, we will get questioned by auditors and regulators. And how do we know whether an asset is impaired? An asset is impaired if carrying amount is greater than recoverable amount. And we know that carrying amount means book value, means cost minus accumulated depreciation, whereas recoverable amount is actually the higher of fair value less cost to sell, meaning net market value or value in use. And what is value in use? It is the discounted future cash flows. So if you've done some finance units, you know what is discounted future cash flows, you know what is present value. So value in use is basically present value. So when an asset is impaired, we will write down to the recoverable amount directly. And we will debit impairment loss, which will affect your P&L, and we credit accumulated impairment loss, which is a contra asset account. So here we can see the difference. Previously, when we talk about revaluation, we actually record the gain or loss in OCI, other comprehensive income. So under revaluation, the gain and loss will not affect our P&L. But when it comes to impairment loss will directly affect our P&L. So that is the difference. And the following indicators would suggest that an asset is impaired. For example, there is a significant decline in market value, market price decline, or there are changes in technological, market, economy, or legal environment, and those changes are unfavorable. They will affect the company adversely or unfavorably. Another factor, the item, the PPE is obsolete, it is outdated, out of fashion, or it is damaged physically, or the asset will only generate less future economic benefits or less cash flows in the future. So if you observe all these indicators, you should write down your asset, your PPE value, and by recognizing impairment loss. So let's go through a student task. So based on the following information, please determine whether an impairment loss shall be recorded. And if so, what is the journal entry? And then you have to prepare an extract of balance sheet showing the carrying amount of the asset. So let's assume that you have actually attempted this question. We know that the cost is $30,000, accumulated depreciation is $5,000. So what we can do here is we calculate the carrying amount. So cost 30K minus 5K accumulated depreciation, carrying amount is 25K. Then we need to identify what is the recoverable amount. The recoverable amount is the higher of fair value less cost to sell or value in use. So among the two figures, we have to choose the higher, which is 18K. Then we compare. In this case, the CA carrying amount is greater than RA recoverable amount. So we need to recognize the impairment loss. Debit impairment loss, credit accumulated impairment $7,000. So for part B of the question, we then prepare the balance sheet extract. We start with motor vehicle, $30,000 minus accumulated depreciation and accumulated impairment, $12,000. And how do we get $12,000? 5K of accumulated depreciation plus 7K of accumulated impairment loss. So the carrying amount for the motor vehicle in this case is 18K. Alright, now we are in the second part of the topic. We look at another type of non-current assets, intangible assets. So just to give you some preliminary insight, and you will learn intangible assets in greater details in more advanced accounting units. So a few decades ago, the success of a company mainly relies on physical asset. Today, ideas and innovation are driving wealth creation. For example, if you look at the components of S&P 500 market value, tangible assets held by top companies have declined, but intangibles invested by top companies have tremendously increased. In this regard, intangibles are increasingly important for companies. ESB 138 defines intangible assets as identifiable, non-monetary assets without physical substance. So what does it mean? Identifiable means separable. We need to show that the intangible can be distinguished from the company, so it can be separately valued or sold. Because of the test of identifiability, most internally generated means self-generated. So self-generated or internally generated intangible assets cannot be capitalized. When we say cannot be capitalized, it means cannot be recognized as an asset. But items that are externally acquired, means you purchase from an external party, can be recorded as an asset, can be capitalized. Intangible assets are not cash. Intangible assets can only create the opportunity to generate cash, but there is no contractual right to receive cash based on intangibles, and therefore they are non-monetary, meaning they are not cash and they are no contractual right to cash. Without physical substance means we cannot touch and see the items. It also highlights that tangibility is not an essential characteristic of an asset, because remember, when we talk about asset definition in topic 1, what is an asset? You need to show that there is a control, there is a past event, there are future economic benefits. But the conceptual framework never mentions that the asset must be tangible, and therefore asset can be tangible and intangible. Tangibility is not a characteristic of an asset. And how do we observe, how do we prove that an intangible exists? We can only look at the economic transaction. We can only use economic transaction, a past transaction, to prove that an intangible exists. For example, if you purchase mining rights, the amount that you paid for the mining right, the contract, the invoice, the receipt will actually provide evidence for the existence of mining right. So examples of intangibles include patents, copyrights, trademarks, brand names, franchises, R&D, and purchase goodwill. So this table shows that most internally generated intangibles, such as customer lists and mastheads, cannot be capitalized, meaning they cannot be recorded as an asset. Why? Because they are self-generated, they are not separable, they cannot be separated from the company, and they fail the recognition of probable future economic benefits and reliable measurement. If there are any expenditures incurred to build a brand name, such as marketing, they must be expensed. And if there is any research expenditure, they must be expensed as well. So you find that for most of the internally generated intangibles, because they cannot be capitalized, their initial measurement is nil, NA, because we cannot record them as an asset. Or even if we want to record them, we have to expense them at cost. But there are some exceptions. For development expenditure and exploration and evaluation expenditure, and usually you'll find exploration and evaluation expenditure in the mining industry. So for development expenditure and exploration and evaluation expenditure, they can be capitalized as an asset, meaning they can be recorded as an asset. And when we record all these as an asset, we will record them at cost. That is the initial measurement. And what about externally acquired intangibles? So for externally acquired intangibles and also goodwill purchased through business combination, they all can be capitalized because they are separable. Because you purchase from an external party, and therefore the intangible that you purchase is separated from the entity itself, is separated from the company itself, and therefore they can be capitalized. They can be recorded as an asset. And also because they fulfill the recognition criteria of asset, meaning the probable occurrence and also reliable measurement tests. And when we initially recognize them on balance sheet, we will recognize them at cost. But the calculation for the cost slightly varies depending on the type of externally acquired intangible. Okay, while intangible assets are initially recorded at cost or historical cost, how do we subsequently measure intangibles? Similar to property, plant, and equipment, we also have the choices between the cost model or the revaluation model. And you know that when we use the revaluation model, it means we use the fair value. However, to use the revaluation model, we need to show that there is an active market, as discussed earlier. And what is an active market? To show that there is an active market, you have to show that there are many buyers and sellers. The items are identical, means they are similar, and the information, the price information is publicly available. But this proves to be problematic to most of the intangibles, because most intangibles like brand name, they are really unique. You cannot find any identical items in the market, and they are not traded that frequently in the market. So because of this reason, most of the intangibles don't have an active market. Because they don't have an active market, when you subsequently measure them or when you subsequently value them, you have to stick to the cost model most of the time. Okay, you have to stick to the cost model most of the time because it is so difficult for intangibles to have an active market. So you cannot really use the revaluation model. Having said that, accounting standards actually tell us that for a few types of intangibles, they do have an active market. For example, franchise, fishing license, taxi license. So all these are actively traded in the market and they are identical. And therefore, you can actually use the revaluation model as subsequent measurement. So, do we amortize, meaning do we depreciate? Do we amortize and do we impair intangibles? It depends on the useful life of intangibles. So what does it mean? If the intangible has limited lifespan, limited useful life, it can only generate future economic benefits for a specified period of time. So in this case, it must be amortized, meaning it must be depreciated. Example would be acquired patent, because you know that the government won't give you the patent forever. Your patent is only up to maybe 10 years, 15 years, or 20 years. And all sorts of assets are subject to impairment tests. So you have to also test intangible assets with a limited lifespan for impairment. And for intangibles that have indefinite lifespans, mean unlimited lifespan, they are not amortized. So you don't depreciate it. So example will be acquired goodwill, because we assume that they can generate future economic benefits indefinitely. And for intangible assets with an indefinite lifespan, meaning unlimited lifespan, they are only subject to impairment testing. Alright, so there are two types of goodwill: internally generated versus purchased goodwill through business combination. Internally generated goodwill cannot be recorded as an asset because it is not separable, but purchased goodwill can. Purchased goodwill is defined as an amount paid for more than the assets are worth. It is calculated as the amount paid for a business less fair value of net assets obtained. So net asset means asset minus liability. Okay, meaning when you purchase another company, you pay a price. If you pay a price greater than the net asset, meaning the equity of that company, then there is a purchased goodwill. And we will look at a simple calculation later. So why sometimes in a business combination you pay more, you are more likely, you are happy to pay more because we pay for the goodwill. And what are goodwill? Goodwill is abstract. It can be due to strategic location. It can be due to strong management. It can be due to strong customer base. It may be due to greater or positive future cash flows, or because the products are well known. So all this constitutes goodwill. So let's look at an example. Assuming the fair value of Man U net asset is $2 billion and Manchester City pays $2.5 billion. So the $2.5 billion is the purchase price. So how much is the purchase goodwill? So $2.5 billion of purchase price minus $2 billion of net asset, fair value of the net asset, which is 0.5 billion. So the purchase goodwill is 0.5 billion. And purchase goodwill can be recorded as an asset on balance sheet. It is not amortized because it has indefinite lifespan, and we will test the purchase goodwill for impairment every year. And purchase goodwill is classified as non-current because of its unlimited useful life. Accounting for intangibles is controversial because people debate whether internally generated intangibles should be recorded as an asset. On the one hand, some people support the idea that we should not record internally generated intangibles as an asset because these items are unique, they don't have an active market. If we were to value internally generated intangibles, we do not have market price to refer to, so we have to come up with our own estimates, and this will introduce subjective estimates that are subject to error and manipulation, which will reduce faithful representation. However, another group of people believe that internally generated intangibles should be capitalized because of consistency argument. If externally acquired intangibles can be capitalized, we should do the same for internally generated intangibles. We should not be biased. And another point is that if we do not record these internally generated intangibles as an asset, it will understate our asset, and therefore it will reduce the relevance of information because internally generated intangibles may generate future economic benefits, and it is too conservative because if we do not capitalize internally generated intangibles, we understate our asset. And in fact, information about internally generated intangibles is relevant for investors' decision making, and investors always reward firms with those intangibles with a premium. That actually explains why the market value of a firm is always higher than the book value of equity. Student task. So for the following items, please discuss the accounting treatment. So in this case, you have customer base, you have acquired patent, and acquired brand. So let's assume that you have attempted this question. You need to discuss the initial measurement, initial recognition, and subsequent measurement of those items. So let's begin with the customer base. In this case, customer base increased by 20% during the financial year. Do you recognize an increase in customer base? The answer is no, because it is not identifiable and the future economic benefits cannot be reliably measured. Because it is not recognized, so we do not have to discuss the subsequent measurement. And for the second item, acquired patent. So the company actually acquired a patent with cash for $500,000. Patent law indicates that the patent is legally valid for 15 years, but the company expects to hold it for 12 years only. So first of all, do we recognize it as an asset? Yes, because it is externally acquired, and we will recognize it as an asset at cost $500,000. The next question is, does it have an active market? ESB 138, the accounting standard says that for patent, there is no active market. Because there is no active market, we cannot revalue patent upward. Is it amortized? Yes, because a patent only has limited useful life. And over how many years? In this case, we will amortize it over 12 years because it is based on the management's best estimate. And there may also be impairment concern because legally, the company can hold the patent for 15 years, but management only holds it for 12 years. So probably management believes that it can only generate future economic benefits for 12 years, but not 15 years. And finally, a brand was purchased for $3 million, and the company estimates that the future benefits from this asset will be generated indefinitely. So first of all, do we recognize the brand name here? Yes, because it is externally acquired. We will record it as an asset at cost $3 million. Next, we need to discuss the subsequent measurement. Does it have an active market? According to accounting standards, there is no active market for brand name, so it cannot be revalued upward. Do we need to amortize brand? The answer is no, because in this question, the brand is expected to have indefinite life. Is it subject to impairment testing? Yes, every asset is subject to impairment test. If it is impaired, then we have to recognize the impairment loss. So that's it for this topic. Please go through revision of case study 9, and we will discuss at the start of the next topic.